Welcome back to the Wealth Channel. I'm Associate Dean Alan McClellan. It's my pleasure to be joined again today by fellow professors Ted Kurlowich, Chris Worley, our Dean and Professor of Investments Walt Werheide, and Craig Lemoyne. Last week we started our discussion of the impact of this new law that extended the Bush-era tax cuts, and I'd just simply like to pick up there where we left off.
The other aspect of this bill, which is totally new, is this portability where you can inherit your spouse's exemption. So the question becomes, if I'm not significantly over $10 million, do I need any kind of significant plan at all? Do I have to have a will with formulas and trusts? And the answer, I think, is yes. The purpose for trusts had much more to do with other aspects than taxes. It had to do with answering the how and when question with your beneficiaries. Everybody that has money has a beneficiary that has some limitations, whether it's a severe disability or permanent immaturity. So we had asset protection reasons for creating trusts that were well beyond the taxes. So to feel comfortable with this 2-year bill, and I'm not going to jump I don't think the estate tax exemption's coming back very much from $5 million. I don't think the rate is going to go up very much higher than 35% even after the 2 years. The myth is, well, I can stop planning. I think you still need to sit down, do the plan, and have it driven by other reasons besides tax anyway. And with this portability of the exemption, this requires the filing of the estate tax return at the first death when otherwise that return's not required. If you're not over the $5 million threshold for tax purposes, you don't have to file an estate tax return. Well, this gives you a reason to file a return that's otherwise unnecessary, and there's a lot of factors in that. What if I'm going to pass away and I don't have that much exemption to leave, but later on my wife could inherit or have a windfall of some type? It would have been prudent to file my estate tax return when otherwise it was unnecessary. So again, I don't think advisors or their clients should take comfort in the big exemption numbers and the portability to say, well, you know, I don't need to seek the advice of my financial planner about the estate plan anymore because it doesn't apply to me. Right. It very well applies to them.
Do you think, Ted, we could ever see an estate taxation regime where, such as we have at the moment, where some decedent estates will have the ability to elect between a carryover basis or an estate tax? One of the arguments against the estate tax has been that death itself should not be the triggering event. But in giving up or in acquiring freedom from estate tax, you should not be allowed to have the appreciation go income tax free, and that's the trade-off. Could you ever see a system where pick one you like as a way of appeasing the proponents?
In other words, make the 2010 treatment permanent.
Yeah, no, I certainly don't think that's going to happen permanently. I think the congressional staffers have heard from the estate bar significantly during the year of 2010. They know exactly what they've done to the probate bar, and I think that would be crazy to put that regime into place, because it also puts the IRS in a compliance bind with what exactly are the income tax basis of these inherited assets. Right now, they have not fixed the problem that the heirs are inheriting these assets, and the heirs are not necessarily bound to what happened in the estate. So there's an additional bill that's going to be coming to clarify and create consistency in the income tax treatment of inherited assets, because right now, absent the year where you can make the election, the heirs someday down the road can sell the assets and challenge what was filed on the return. So there's an inconsistency in that. To create an election to further obfuscate that scenario is just ridiculous.
Walt, I know you've been taking a close look at the alternative minimum tax, the AMT, and I understand that we have a patch to that at this point. Can you kind of set that up and explain what has occurred with that?
Right. I have to say the AMT has always been one of my favorite because every year I manage my withholdings based on the standard tax tables, and then I have the excitement of discovering at the end of the year, as Professor Kurlowitz says, I must be one of the really well-off people because I end up owing some more. Badge of honor, yes. I owe some more under AMT. And I have to say that when I bought my tax preparation product at the end of last year and ran the first pass on taxes, the amount of tax I owed really made my eyes pop because of the way the AMT was headed.
For our audience, just in a few words, what's the theory behind the AMT? Why did Congress install that?
The Congress installed it years ago when there were, I believe, around 21 people who had very large incomes, and through proper use of income tax planning, managed to avoid paying any income tax. And that just struck some of our elected officials as somehow wrong. Okay. Or maybe they just felt that they wanted some tax revenue here.
Well, in fact, that was the inspiration for its passage in 1969. And the limits and the exemptions have had very little increase over the 41-plus year history, and that's the reason why it's become more and more concerned. The exemption has not kept pace with the growth of income.
It's affected more and more middle class.
Sure. Right. Yeah. In fact, if they had not made the patch, the estimate is that an additional 21 million households would end up owing some taxes under the AMT structure.
Well, there goes your payroll benefit.
Right. Now, I know there's a little over 300 million people in the country. I'm not quite sure how many households there are, but if you figure 3 to a household, that makes about 100 million households, which makes that about 20% of the population. So there would have been a very rude awakening for a lot of people had that stayed in place. And what the patch does is essentially put the exemption amount pretty much back where it was in 2010. It raised it a little bit. And the exemption amount, had they not put the patch in, would have been $30,000 lower. It goes from it will be almost $75,000 for a married couple filing jointly. It would have gone back to $45,000, and so you figure $30,000 at a 26 or 28% tax rate. We're talking close to $7,500 for somebody who would be fully impacted by that change in the exemption amount. So, and of course, that's where you're at an income level where people have a lot more choices about spending their money. I'm still sticking to my story. I'm not sure they're going to go out and buy that big screen TV, but it does allow them to do a lot more in terms of financial planning. And for individuals, the exemption amount would have dropped by $15,000. So,
well, Dean or Heidi, I will tell you there's a difference between consumer behavior and government behavior, because as they put together these tax estimates and revenue losses and revenue gains, the government is doing all of its planning and what they tell their citizens about the costs of what they're doing, as if that AMT patch is going to go away in 2 years. And they're going to collect all this extra revenue, and we all know that's not going to happen. So the government, in fact, takes a short-term revenue loss in terms of a tax benefit they're providing the public and continues to spend as if they're going to get the money they know they're never going to get.
And Ted, you would not be surprised to know that, in fact, it's been calculated with precision. Approximately $16.8 billion for the year 2013 is part of the revenue side of the equation.
Sure.
So,
everyone, thanks for joining us today. I'm looking forward to picking up this conversation in our next segment.